There's a pattern in banking history that has wiped out the savings of millions of people across 3 countries in the last 15 years. And right now, in 2025, the United States is following that exact same pattern stage by stage, policy by policy, reading from the same playbook that destroyed depositors every time before. In 2013, Cyprus froze all bank accounts overnight. When they reopened, 47% of deposits over 100,000 euros were gone, taken to save the banks. In 2015, Greece closed all banks for 3 weeks. When they reopened, €60 daily withdrawal limits. Your money was trapped. In 2019, Lebanon froze accounts. Your dollars were converted to worthless Lebanese pounds at fake exchange rates. Life savings gone. 3 countries, 3 banking collapses, 3 complete wipeouts of depositor wealth. And here's what should terrify you. The United States has already completed 4 of the 6 stages. We're not approaching the pattern. We're deep inside it. This is the story of how banks collapse, why governments always choose banks over depositors, and why the math says American savers are next. If you want to understand what's coming and how to protect yourself, hit that like button and subscribe, because what I'm about to show you isn't taught in economics classes, and the banks definitely don't want you to know it. Before we go through the pattern, you need to understand what a banking collapse actually looks like. Not in theory, in practice. What it means when your money is in the bank and suddenly you can't access it. Banking collapse doesn't start with riots or revolutions. It starts with debt. Too much government debt, too much bank lending, too many bad loans that will never be repaid. At first, everything looks normal. Banks are open. ATMs work. Your account balance shows your money is there. But beneath the surface, the system is breaking. Banks are insolvent. They owe more than they own. Government debt is unpayable. Foreign investors are pulling out. And the people in charge are making a decision about who pays for the mess. Here's what most people don't understand. When a banking system fails, there are only 2 options. Either taxpayers bail out the banks with public money, or depositors bail in the banks with their own savings. After 2008, politicians decided taxpayer bailouts were too unpopular. Too much public anger, too much political cost. So they created a new system, bail-ins, where your deposits become the solution. Then comes the moment of truth. The government faces a choice. Let the banks fail and protect depositors, or sacrifice depositors to save the banks. Every single time, they choose the banks. And when that choice is made, your deposits become the solution. Not through traditional bankruptcy, through something much more sophisticated. Bail-ins, capital controls, forced currency conversions, legal theft that happens overnight while you sleep. Let me show you how it actually happened 3 times the exact same way. Let's start with Cyprus. March 2013. Cyprus was part of the European Union, part of the Eurozone. Deposits were insured up to 100,000 euros by EU regulations. People felt safe. This was modern Europe with banking regulations, deposit insurance, and government guarantees. But Cyprus banks had made massive loans to Greece. When Greece's debt crisis hit in 2011 and 2012, those loans went bad. Cyprus banks became insolvent, and the size of the problem was staggering. By early 2013, Bank of Cyprus and Laiki Bank were bankrupt. They needed 10 billion euros, more than half of Cyprus's GDP. The government couldn't afford a bailout. To put that in perspective, it's like if tomorrow American banks needed $20 trillion in bailouts. Impossible, unsustainable. The EU refused to provide the money without conditions, and those conditions were brutal. On March 16, 2013, the government announced a bank holiday. All banks closed, no ATM withdrawals, no wire transfers. Your money was locked inside the system. People panicked. They rushed to ATMs before they were shut off. Lines wrapped around blocks. People tried to withdraw everything they could. But the banks had already closed electronic access. International transfers were frozen. Credit cards stopped working abroad. For businesses, this was catastrophic. Imagine running a company with employees to pay, suppliers demanding payment, and suddenly you can't access any of your money. For days, nobody knew what would happen next. Here's where it gets brutal. On March 25th, the government announced the terms. Deposits under 100,000 euros were protected, but deposits above that were converted to bank equity. If you had more than 100,000 euros in Bank of Cyprus, 47.5% was taken, converted to worthless shares in a failed bank. Think about what that means. If you owned a business with 500,000 euros in your account to make payroll, you just lost 190,000 euros. If you were a retiree with 200,000 euros in savings, you lost 47,500 euros overnight, without warning, without appeal. Business accounts, retirement savings, money people had saved for decades, gone, and in exchange, you got shares in a bankrupt bank that would never recover their value. When banks reopened, strict capital controls were in place, daily withdrawal limits. You couldn't move money out of Cyprus. These controls lasted for 2 years. Cyprus today has never fully recovered. People who lost their savings never got them back. The economy shrank by 10%. Thousands of businesses closed. An entire generation of Cypriots learned not to trust banks. That's what a banking collapse looks like in a modern, developed country within the European Union. Now let's look at Greece. June 2015. Greece had been through years of austerity and bailouts. By 2015, people thought the worst was over. The economy was stabilizing. Tourism was returning. Property prices were recovering. The crisis seemed to be ending. But Greece still owed hundreds of billions in debt, and negotiations with creditors were breaking down. What happened next shocked the world. In June 2015, rumors started spreading that Greece would leave the euro. People panicked. They rushed to ATMs to withdraw cash. They tried to move money to foreign banks. They converted euros to dollars. In 1 week, Greeks withdrew 8 billion euros from their bank accounts. The banking system was bleeding cash and couldn't stop it. Banks were running out of physical currency. The system was on the verge of total collapse. On June 28, 2015, all banks closed for 3 weeks. ATMs were limited to 60 euros per day. Wire transfers blocked. Credit cards stopped working internationally. When banks reopened on July 20th, capital controls were in place. Weekly withdrawal limits of 420 euros. No transfers abroad without approval. These controls stayed for years. Greece didn't do a direct bail-in like Cyprus, but they achieved the same result differently, through a more sophisticated method that most people didn't even understand was happening. The government forced banks to buy more Greek government bonds. Those bonds were trading at massive discounts because everyone knew Greece couldn't pay. But Greek banks had to buy them anyway. When those bonds lost value, the banks lost money. Where did that money come from? Depositors. The losses were passed through bank consolidations, reduced interest rates, and fees. Your deposits were being eroded, but slowly. Death by 1,000 cuts instead of one dramatic haircut. And with capital controls in place, you couldn't move your money to safety. You were forced to hold deposits in failing banks while they slowly lost value. You could see it happening. You just couldn't stop it. The pattern played out again. Bank insolvency, government intervention, your deposits trapped, wealth destroyed, just with a different method. Now let's look at Lebanon, starting in 2019. Lebanon was the Switzerland of the Middle East. Lebanese banks held over $170 billion in deposits from across the region. But the government was running massive deficits, and the central bank was paying unsustainable interest rates. The whole system was a Ponzi scheme. In late 2019, without any official announcement, Lebanese banks simply stopped allowing dollar withdrawals. If you had dollars in your account, you could see the balance, but you couldn't take them out. Banks started making their own rules. Some allowed $200 per week, some allowed $1,000 per month. There was no consistency, no law, just arbitrary restrictions. Here's where it gets diabolical. The official exchange rate was 1,500 Lebanese pounds per dollar, but on the street, the real rate was 15,000 pounds per dollar, 10 times worse. Banks started forcing depositors to convert dollars to Lebanese pounds at the fake official rate. You had $10,000 in your account. The bank would let you withdraw it, but only in Lebanese pounds at 1,500 per dollar. So your $10,000 became 15 million Lebanese pounds. But when you tried to use those pounds, the real value was only $1,000. You just lost 90% of your savings through a government-mandated currency conversion scam. People would go to the bank with dollars on their account statement and leave with nearly worthless local currency. Legal robbery, sanctioned by the government, enforced by the banking system. By 2022, the Lebanese pound had lost 98% of its value. Banks stopped allowing any significant withdrawals. Your account might show $50,000, but you can't access it. You can see the balance. You just can't touch the money. People's life savings are still trapped in the banking system today. Retirement accounts, business funds, emergency savings, all worthless, all inaccessible. There have been bank hostages. Depositors literally holding bank employees at gunpoint demanding their own money back. People storming bank branches. Desperate acts by desperate people who watch their life savings vanish. And still, the government does nothing. The banks do nothing. In 2023, the IMF officially declared that Lebanon's banking sector losses exceeded $70 billion. That's money that's simply gone, vaporized. Depositors' money. And here's the key detail. The government has made it clear. Depositors will bear the losses. not the central bank, not the government. Not the bank owners who made the bad loans, the people who trusted the system, the people who deposited their savings. The IMF's restructuring plan explicitly states that depositors with large accounts will face haircuts, just like Cyprus. Deposits above a certain threshold will be converted or written down. The exact percentage isn't decided yet, but the principle is established. Your money pays for the crisis. Lebanon is still in collapse today, 6 years later. Banks are open but worthless. People's savings are gone. The country has become a cautionary tale. A warning that nobody else is heeding. The pattern completed fully, and it's still ongoing. Before we look at where America is right now, you need to understand how this mechanism actually works. Not the theory they teach in economics class, the real mechanism. The dark machinery that transfers wealth from ordinary people to failing banks. Why does this pattern keep repeating? Why do governments always choose banks over depositors? And why do they always use the same playbook? Because the system is designed this way, deliberately, legally, officially. Let me show you. Banks don't actually have your money. For every $100 you deposit, the bank keeps maybe $10 and lends out $90. This works fine in normal times. But when crisis hits, everyone wants their money at once. And the bank doesn't have it. It's been lent out to borrowers who may never pay it back. That's the trap. The system is designed to fail if people lose confidence. And once that confidence is lost, the bank run becomes self-fulfilling. The fear of losing your money causes everyone to try to withdraw, which guarantees the bank fails. Banks and governments are partners. Governments run deficits and need to borrow. Who buys government bonds? Banks, using your deposits. When government debt becomes unpayable, banks are holding worthless bonds. When banks fail, the government loses its main buyer of debt. They're locked together. That's why governments always bail out banks. And to save the banks, they need money, more than the government has. They can't just tax people enough. There would be riots. They can't cut spending enough. The system would collapse. So where does it come from? Your deposits. It's the only pool of money large enough to solve the problem. After the 2008 financial crisis, governments around the world changed the rules. They created a legal framework for what's called a bail-in. In the old system, when banks failed, governments would bail them out with taxpayer money. This was politically unpopular. People were angry. They didn't want to pay for banker mistakes with their tax dollars. So they created a new system. Instead of taxpayers bailing out banks, depositors would bail in banks. Your deposits would be converted to bank equity, bank ownership. You become a shareholder in a failing bank instead of a depositor with guaranteed funds. This is now legal in the US, the EU, Canada, Australia, and dozens of other countries. The laws are already on the books, the Dodd-Frank Act in America, the Bank Recovery and Resolution Directive in Europe. These aren't proposals. These are enacted laws. It's not a conspiracy theory. It's official policy. The International Monetary Fund published guidelines on how to implement bail-ins. The Financial Stability Board coordinated the global adoption. This is the new standard for bank failures. Now let me show you how these pieces fit together into the 6-stage pattern. This is mathematical. This is predictable. This is how it always happens. Government debt grows too large. Banks buy government bonds using depositor funds. When the government can't pay, a debt crisis becomes a banking crisis. The connection is direct. The risk transfers from government to banks to depositors. Banks holding bad debts become insolvent. They owe more than they own, but they keep operating. Regulators look the other way. Everyone pretends everything is fine. This can last months or even years, until it can't. People start to figure it out. Deposits begin flowing out of the country. Smart money moves first. Then everyone else follows. Bank runs start. The system begins to crack. This is the acceleration phase. Once it starts, it moves fast. The government steps in. Bank holidays, withdrawal limits, transfer restrictions. Your money is trapped inside the banking system. They tell you it's temporary. It never is. Cyprus kept controls for 2 years. Greece for 3 years. Lebanon still has them 6 years later. Deposits are converted to bank equity, or forced into local currency at bad rates, or simply frozen indefinitely. The method varies by country and by law, but the result is the same. Your savings disappear, legally, officially, permanently. After the crisis, strict controls remain. Banking privacy ends. The government monitors every transaction. CBDCs replace cash. And most people accept it because they're told the alternative is worse. The crisis becomes the excuse for permanent control. This is the playbook. This is how it works. And once you complete stages 1 through 3, stages 4 through 6 become almost inevitable. Cyprus, Greece, and Lebanon all followed this exact sequence. The timing varies, The specific methods vary, but the pattern is mathematical. And America is already at stage 4. Duration, 1521. Word count, to 1,600 words. Now let's talk about the United States in 2025, and why every warning sign is flashing red. Let me show you where we are. The United States government owes $36 trillion. That's 120% of GDP, higher than during World War II. Interest payments on that debt are now over $1 trillion per year. That's more than we spend on defense, more than we spend on Medicare. We're borrowing money just to pay the interest on money we already borrowed. And who's the biggest buyer of U.S. government debt? American banks. They hold over $4 trillion in treasury bonds and mortgage-backed securities. Just like Cyprus banks held Greek debt. Just like Lebanese banks held government debt. When the government debt goes bad, the banks holding it become insolvent. And when the banks are insolvent, your deposits are at risk. Same setup, same trap, same pattern. In March 2023, Silicon Valley Bank collapsed, then Signature Bank, then First Republic Bank. 3 major bank failures in 2 months. Why? Because when interest rates rose, the value of their bond holdings crashed. Banks were sitting on hundreds of billions in unrealized losses. The FDIC estimates that U.S. banks have $620 billion in unrealized losses on their bond portfolios right now. That's banks owing more than they own on a mark-to-market basis. Technical insolvency, just like Cyprus, just like Greece, just like Lebanon. And the government's response? They guaranteed all deposits at the failed banks, not just up to the $250,000 FDIC limit. All deposits, billions of dollars. Where's that money coming from? They created a new lending program, the Bank Term Funding Program, which is just the Federal Reserve printing money to cover bank losses. And who ultimately pays? Depositors, through inflation, through bail-ins, through the system that's already in place. The FDIC's Deposit Insurance Fund only has about $125 billion. If we have widespread bank failures, that fund won't even cover 10% of insured deposits. The system only works if most banks don't fail at once. But in a real crisis, they will. When SVB collapsed, over $40 billion were withdrawn from regional banks in a single week. The fastest bank run in American history. Digital banking made it instant. People could move millions with a phone app. People are waking up. They're moving money from small banks to big banks, from banks to money market funds, from dollars to gold and Bitcoin, from the financial system to anything that feels safer. Foreign central banks are selling U.S. Treasury bonds. China reduced holdings by over $300 billion in the last 3 years. Japan is selling. Saudi Arabia is diversifying into yuan and euros. Even allies are slowly moving away from dollar dependence. The BRICS nations are building alternative payment systems. They're trading in local currencies. They're accumulating gold. Russia and China settled over 90% of their bilateral trade in rubles and yuan in 2024. The dollar's monopoly is breaking. This is stage 3, loss of confidence. It's happening in slow motion compared to Cyprus or Greece, but it's happening, and once confidence is lost, it's almost impossible to restore. The infrastructure for capital controls is already in place in America. Banks must report cash transactions over $10,000. Wire transfers are monitored. The Bank Secrecy Act and Patriot Act expanded surveillance. The IRS now requires reporting on accounts receiving over $600 in transactions. The government can see every significant financial move you make. That's the infrastructure for capital controls. When the next crisis hits, they can flip a switch. Limit withdrawals, restrict transfers, lock down accounts, just like Cyprus, Greece, and Lebanon. We've completed stages 1 through 4. America has excessive debt. Banks are technically insolvent on mark-to-market basis. Confidence is eroding. And the infrastructure for capital controls exists. We're not at the end yet, but we're past the halfway point, and the next 2 stages come fast. Stage 5 is the bail-in. That's when your deposits get converted to bank equity, or when withdrawal limits become permanent, or when your dollars in the bank become digital dollars you can only spend in approved ways. The legal framework is ready. The Dodd-Frank Act allows it. In 2010, the FDIC published a paper called Resolving Globally Active, Systemically Important Financial Institutions. Page 10 explicitly discusses using depositor funds in a bail-in. It's not hidden. It's not a conspiracy theory. It's official policy. The playbook is written. The laws are passed. The system is ready. Stage 6 is the new normal. That's when the crisis is over, but controls remain. When central bank digital currencies replace cash. When the government can see and control every transaction. When financial privacy is dead and capital controls are permanent. We're not there yet. But the path is clear. The pattern is playing out. And the math says stages 5 and 6 are coming. 3 countries followed this pattern: Cyprus, Greece, Lebanon. Each believed it couldn't happen to them. They were all wrong. Right now, Americans are saying the same thing. We're America. We have the Federal Reserve. We're the reserve currency. But the pattern doesn't care about exceptionalism. You cannot run $36 trillion in debt forever. You cannot have insolvent banks forever. You cannot lose global confidence and maintain reserve currency status forever. You cannot avoid stages 5 and 6 once you've completed stages 1 through 4. The sequence is mathematical. It's not politics. It's not policy. It's arithmetic. The only question is timing. 2 years? 5 years? 10 years? But the pattern says it's coming, and when it comes, it won't be slow. Every historical example shows the same thing. The collapse happens faster than anyone predicts. Cyprus depositors had 48 hours warning. The banks closed on a Saturday. By Monday, the terms were announced. Greek depositors woke up to closed banks with no warning. Lebanese depositors still can't access their money 6 years later and have no idea when or if they ever will. When the crisis hits, there won't be time to react. The controls will already be in place. The accounts will already be frozen. The bail-in terms will already be decided. And your deposits will already be gone. Look, I'm not telling you this to scare you. I'm telling you because the pattern is clear and most people aren't paying attention. The warning signs are everywhere if you know what to look for. You can't change the system. You can't stop stage 5 and 6 from coming. But you can protect yourself. You can understand the warning signs. You can know where we are in the pattern. And you can have a plan for when the next banking crisis hits. Knowledge is power. Understanding this pattern means you won't be caught off guard. You won't be the person standing at a closed ATM wondering what happened. You'll be the person who saw it coming and prepared accordingly. Because it will hit. The math guarantees it. The pattern demands it. And history shows it happens faster than anyone expects. If this video showed you something you didn't know, if it connected dots you hadn't seen before, do 2 things. First, hit that like button. It tells YouTube to show this to more people. And more people need to understand what's coming. Your like helps this information reach people who need to see it. Second, subscribe. Because when we hit stages 5 and 6, when the banking crisis goes from slow motion to full speed, you'll want to understand what's happening in real time. You'll want to know what to do. You'll want to see the warning signs before they become headlines. Before the banks close. Before the controls are announced. Before your deposits are frozen. The answers aren't hiding in the future. They're written in the past. Cyprus, Greece, Lebanon, they already showed us the playbook. Every move, every stage, every excuse the government will use. America is just reading from the same script. We're on page 4 of 6, and the next pages are already written. I'll be here showing you every page as it unfolds. Subscribe now, because when this hits, information will be the most valuable asset you have.